Scalping seems like the holy grail of trading, doesn't it? Fast money, quick profits, the thrill of getting in and out and getting on with your day. Just making that money and having the rest of the day to do whatever you want. But what if I told you that there is something called the scalping trap? And the moment you fall in, one small mistake can wipe out all of your hard-earned gains in seconds. Today, I'm bringing you a video that will break down the true reality of scalping and reveal why so many traders fall into this trap. And the person teaching it, this is not just any trader, guys. This is a former eye surgeon, MD, who left medicine to trade full time. And after 30 years of trading experience and nearly 2 decades of teaching and 15 books authored on price action, his strategies have shaped the way traders approach the markets all over the world, including this guy. And by the end of this video, I promise you, you are going to see scalping in a completely different way. Let's get into this video by the godfather of price action himself, my mentor, Al Brooks.
I'm going to begin by talking about stop orders and limit orders and why I think they are opposite bets. Then I'll talk about scalping within a trading range. I'll move on to talking about why beginners lose when they trade with limit orders. Next, I'm going to be talking about scalping and strong trends. And finally, I'll talk about what everybody should be doing, and that is patiently waiting for trends.
Now, as we move forward, I'm going to hit you with some pop quiz questions to make sure you're watching and learning. Okay, so be ready for those.
I said that a stop order is the opposite of a limit order, and I'm going to explain why I say that. A bull buys with a stop above the high of a bar, betting on a trend. So he'll buy above the high of that bar.
And for anyone unfamiliar, a stop order means you place your order here and you enter once you get swept into the trade. Your order only gets executed if the price surpasses that entry.
He'll place an order to buy 1 tick, or if it's a Forex market, 1 pip above the high of the prior bar. This bar has a high below that bar, so it's a pullback. He's buying as the market goes above the high of this bar. So the market's breaking out above this bar. He's hoping the breakout will continue into a trend. A stop order is a bet on a trend. You're hoping that the market will continue up far enough so that you can take a profit. For example, if you buy here, you might take profits here if you're a scalper. When the market's trending, there'll be many more profitable stop order trades and fewer profitable limit order trades. Every trade requires someone doing the opposite of what you're doing. When a bull buys with a stop order, someone else sells, and they're selling either with a limit order or a market order. You should think of stop and limit orders as opposite bets. At the high of a bar, bulls buy with a stop just above the high of the bar, and a bear sells with a limit order at the high of the prior bar, betting that if the market goes above that bar, the breakout will fail and the market will reverse down.
Okay, so we have 2 different order types to go with 2 different types of trades. Now, Al Brooks is the only person I've ever heard this from. So this is maybe the first time you're hearing this, but he's saying that if you are scalping, you're going to be using a limit order because you're looking for a reversal. If you are going with the trend, then you are going to be using a stop order. Okay, so stop orders for stop order trades, which means with trend. Limit orders for reversal trades, which means counter trend. You got me?
A bear will often use a limit order to sell at the high of the prior bar. He's betting that if the market goes above the high of the bar, instead of continuing up, the breakout will fail and it will reverse down. A limit order trader is betting on a reversal. The market's going up, he's selling, betting that it will not go up very far before it goes down far enough for him to make a profit. A lot of limit order scalpers are willing to scale in, sell more if the market goes against them. So if this bear sold at this high, he might sell more at the distance of a scalp. So for example, if this were the E-mini, he might be scalping for 1 point. He's selling here, hoping it falls 1 point and he can make a profit. If he's looking to scale in, he might sell more 1 point higher and maybe more 1 point above that. Remember, a limit order is betting against a trend. The market is going up and you're selling, betting that it'll go down far enough for you to make some profit. For example, a bear scalper selling here might take profits here.
Okay,
So
now why would that be the case? Because we went above this candle and then we moved down, right? And then we're moving above the next candle and then we're moving down again. So what you see a lot of reversals like this, right? Like, look, this candle is inside this candle. So it went up, then it went down, then we went up, and then we went down again. So you're seeing the market reversing a lot, which is the conditions that show you that scalping is most likely going to work when there's lots of reversals.
sold here, betting the breakout would fail, and then he takes his profit. I said that when the market is trending, there will be far more good, profitable stop order trades than limit order trades. People betting on trends are going to make money. Trading with stops is a bet on a trend.
Okay, now here's your first pop quiz question. Now I want you to post your answer in the comments so I know that you're not here for your own entertainment, okay? You came here to learn something so you can get some better results going in your life with your trading, okay? So here's a pop quiz question. Show me that you're here to learn something. In a trading range, okay, should you rely more on stop orders or limit orders? In a trading range, when you're scalping, should you rely more on stop orders or limit orders? Post it in the comments right now so I know you're paying attention.
When the market's in a trading range, there'll be far fewer profitable stop order trades and far more profitable limit order trades. Because in a trading range, you're getting a lot of reversals, and a limit order trade is a bet on reversal. Remember, I said that every trade requires someone doing the opposite. When a bear sells with a limit order, someone else is buying, either with a stop order or with a market order. At the high of the bar where the bear is selling, a bull is buying, betting on a trend up.
Now, this is one of the keys to being successful in any trading strategy. Do you understand your position and the counter position? It's a trade. What does that mean? It means this. It means a buyer and a seller. So if you only understand, and most traders only understand their position, they only understand what they think's happening. But you have to understand that a trade is this. You have a buyer and a seller. So everything you think, someone thinks the opposite. And if you want to elevate your level of understanding of the markets and increase your likelihood of success in your strategy, you want to be able to move to understanding counter logic. And by counter logic, I just mean you see it from your perspective, which is what you think is going to happen. Then you see it from the other perspective. Now, if you have a position in the market and you think the market's going to do something, and you not only consider your position, but you consider the counter position, and you still think that your position is valid, then that's a very strong trade to take. But most traders skip the step of understanding the other side of the trade. And Al is saying and reminding us that every single time that you think A, someone else thinks the opposite, B.
A bear looking to sell with a stop order is going to enter on a stop one tick below the low of the prior bar, or 1 pip in a forex market. This low is above that low, so this is a pullback, and bears will short 1 tick or 1 pip below the low of that bar. And he's hoping the market's going to fall far enough for him to scalp, and then he'll take his profit at whatever predetermined profit target he wanted.
Okay, and the pop quiz question, you guys got it right. People are saying in the chat, limit orders. Yes, Charles, limit orders. You guys are getting it. Limit orders. Okay, so the answer is in a trading range, you want to be looking for reversals using limit orders. Nice work. Next question coming soon. Keep paying attention.
A bull scalper looking to enter with a limit order will buy at the low of the prior bar, betting that the breakout below the bar will not go very far, and that the breakout will fail, and the market will reverse. So the bull will buy at the low of that bar, betting that the market will go up, and he can make a profitable scalp. For example, he might exit right there. I want to talk a little bit about scalping in a trading range. Obviously, a trading range, lots of sideways bars, 4 sideways bars here, lots of reversals, down, up, lots of prominent tails. All of those things happen in trading ranges. The more of that you see, especially early in the day, if you see a lot of bars with big tails, a lot of bars sideways, 3 here, 4 or 5 here, and a lot of alternating in an absence of consecutive big bull bars or consecutive big bear bars, the market's probably in a trading range.
Okay, so really quick, let's add some detail here. Notice lots of tails. Every single candle on this chart has lots of really big tails. Notice they're not just little tails. Like most of the candles don't look like this, where there's a significantly sized bar body with a small tail. No, most of the candles look like this, where the tail is huge, okay? Big tail, big tail, big tail, lots of tails, okay? Or you can call those wicks, whatever. Lots of little dojis, okay? Now, technically, and this is where things get a little tricky. Look at the high here, and look at the high here and look at the high here. You're actually technically getting higher highs. Look, higher highs. This high is higher than this high. This high is higher than this high. So we got higher highs. What else do we have? We've got higher lows because the low is here. Now it's here. And this low is higher than this low. And then look at this low. This low is higher than this low. Okay, so we've got higher highs and we've got higher lows. That's technically a bull trend, but he is calling this a trading range. Now, why? Because this is effectively a trading range. Look, the price went a couple points above that high and then reversed down. And every time the price gets to a new high, it goes a couple points above, if that, maybe a few ticks above, and then reverses down. Okay. So if you are trading this like a trend, you would get wrecked. You want to trade this like a trading range because this is effectively a trading range, okay? It's a trend, but it's barely a trend, and it's more of a trading range than a trend. And how can you tell? If you want to forget everything I said and just remember one thing, just look at the size of the tails and all of the overlap. Do you see how all the bars are kind of smushed together? That's a signal of trading range price action, and that will tell you, it will tell you hints as far as what kind of trades you want to be looking for.
Now, I want to keep coming back to a certain point. If you want to make a living as a trader, you have a much better chance of doing it if you swing trade and enter with stop orders. And some days, unfortunately, are mostly sideways. You'll be disappointed after you enter. You'll buy.
80% of days are trading range. 80% of the price action on any chart, any time frame, the market is in a trading range. So if you're waiting for a trend, you're going to be 8 out of 10 times you're going to be sitting there on your hands, just waiting. Okay. So one, you can just sit and wait and just avoid trading ranges and only trade with the trend, or you can actually start to learn how to trade trading ranges. Now, Al does not recommend that, but I think it's worth understanding this scalping trap, because as long as you can avoid the scalping trap, then you can work towards getting good at trading reversals and trading in a trading range, which would be appropriate for scalping.
Hoping for a trend up, it doesn't go very far. You'll sell, hoping for a trend down, it doesn't go very far, and you'll end up scalping out. If you're taking entries in a trading range, you should be scalping, because you're not going to get much of a trend, and the market's constantly going to reverse. And if you hold, the market will come back to your entry price and you'll have given back all of your profit.
Okay, so that's just what we were saying, right? Like if you wait until you're getting a clear sign of a trend, and let's say you bought here, right? Because now you've got some closes above the moving average. Like look, if we circled this, we'd say, okay, the price went down here, it's reversed up, then it came back down, and now look at the moving average is mostly holding up the price, and you've got all these closes above the moving average, which is a sign of bullishness. So right here, the market looks bullishness, and then you have two strong bull bars, both closing on their highs. If you got long here, expecting a trend that the price was going to go up here, right? After this, maybe break out, short little pullback, and then break out more to the upside, you'd be very disappointed, because all the price did is it went maybe 2 or 3 points above this candle, and then it reversed all the way down. So all Al is saying is when the price looks like this, when the price action looks like this, right? All the signs that we just pointed out to you, most traders are actually scalping, okay? So if the institutions or the smart money is scalping and they're going for small little reversals, then you want to get with the flow. It's like a surfer in the ocean. You want to get what the ocean is doing and get with the flow. Get with the flow instead of trying to force your ideas on the market. So this is going to help us understand how to do that.
So if you're going to trade in a trading range day, there'll be an occasional swing trade, but most of what you'll be doing is scalping, taking quick profits.
Right. Look how many reversal trades there are, right? Like a reversal trade would be, you'd maybe buy below this strong breakout to the downside, expecting it to fail. Then the price reverses up. Okay. So there's a limit order trade, which would be a scalp. Or what if you did the same thing, right? This trade right here, instead of going for a trend, expecting it to break out and trend up, what if you expected the opposite, which is a failed breakout? Now the price tried to do that, but then you see this bear bar and then they move down. So instead of expecting a trend, expect a breakout to fail and then reverse and get sucked back down into this trading range. That's a much more effective strategy when the price action looks like this, and there are way more opportunities for that. So if you are sitting there frustrated, bored, waiting for a trend, this is an alternative.
Instead of holding for trends, because most of the trades won't go far enough for you to make a swing profit. Again, sideways bars here. These 4 bars are overlapping one another. Here we have 5 or 6 bars overlapping one another. We have a lot of small bodies, a lot of big tails. A tail means the market went up and went down. It went down, it went up. Trading range trading, reversals. The more of that you see, the more likely the day is going to be a trading range day. Think opposite. When things look bullish, it's time to sell. When things look bearish, it's time to buy. Here, very bearish, didn't go down very much. Traders who bought down here made money. Here, very bullish. Traders who bought lost money. Traders who sold made money. Very bullish breakout. You make more money selling that close than buying it. You got to be thinking opposite.
And those are all the entries.
When you're trading in a trading range, you're looking to buy a reversal up in the bottom third, especially if there's a second signal. Here's the first reversal, and here's the second signal. You buy it on a stop, 1 tick above a bar closing near its high. That's what a stop entry trader will do in a trading range day. And bears will do the opposite. They're looking to sell a reversal down in the upper third of the range, preferably below a bar closing near its low. And a second consecutive signal is a higher probability trade. First reversal, second signal here. And they're taking quick profits.
Okay, next pop quiz question. Next pop quiz question. Now, I want to make sure you guys are not just here for your entertainment, right? We came to learn something so that we can actually make some money here, okay? So here's the next quiz question. In a trading range, when is the best time to enter, okay? And this is true or false. This is true or false, okay? So, is the best time to enter when it looks mostly bullish or bearish? True or false? The best time to enter in a trading range is when the market looks mostly bullish or bearish. True or false? Put your answer in the comments right now. Show me that you're paying attention.
Remember, in a trading range, things look most bullish or most bearish when it's about to reverse. And therefore, traders will look to buy the close of big bear bars near the bottom of the range and sell the close of a big bull bar near the top of the range. These are limit order traders, traders looking to enter with limit orders. A big bear bar near the low, you buy, you buy, you buy, you buy. And you keep doing that all day, and you're taking quick profits. You're looking for scalps. If there's a big bull bar, you're more likely going to make money if you sell, especially if you can use a wide stop and scale in. So every big bull bar in the top half or top third of the range, traders will sell, they'll use wide stops, and they'll scale in, and they'll exit with a scalp, a quick profit.
Notice he said wide stop. Most traders use a tight stop in a trading range. That is not a good idea. Using a tight stop in a trading range is almost guaranteed to fail. If you're in a trading range and the market's constantly reversing and the price is constantly going a couple points above a candle and then reversing, if you have your stop here, right, and you're entering here, then it's very likely that you'll get stopped out. So in a trading range, if you're scalping, it's much more effective to use a wider stop as opposed to a shorter, tighter stop.
Limit order traders will also buy below a prior low. They'll have a limit order to buy below that low, below this low, below that low, and they'll look to sell above a prior high. They'll place a limit order to sell at this high.
You see that? Look, if you had your order set to buy below this candle, this bear bar right here, look, the price, you can see that's what traders are doing because the price went right down here and reversed up. And then look, it happened again. The price, market reached down here, and as soon as it got down here, the fact that this has a big tail on here shows you that there were so many buyers here. It shot the price up. So the price action is telling you what traders are thinking. They're thinking that as soon as the price gets down here, we're going to buy because we feel so convicted that the price is not going to continue in that down direction and instead reverse up. And the same thing up here, right? We pointed that out to you earlier. Look, we just go a little bit above it. And then there's so many sellers up here that the price never gets there, or it gets a little bit into that area and then boom, it gets shot right back down towards the moving average.
High and sell more higher. At this high, sell more higher. Every prior low they look to buy, and they're looking for scalps. And they'll sell at a prior high. They'll have a limit order at this high. They'll get filled here looking for a scalp. And they do that all day long. Lots of opportunities to buy at prior lows and sell at prior highs. Exit with a scalp, a small profit. If you put it all together, there are a lot of opportunities to buy. You buy at a prior low, you buy a reversal up from the bottom third, you sell at a prior high, you sell a reversal down from the prior third, you buy bear closes near the bottom, you sell bull closes near the top. Lots and lots of opportunities to make money. So what's the catch? If there are so many opportunities to make money, why am I warning about trading in a trading range? If you're a very good experienced trader, you can do it and make a lot of money. I personally don't find it fun. I do it, but I don't find it fun. And when you're a trader, there are two things you should always be aware of. You should always be thinking about two things. You have to be trying to make money. You're doing this for a living. And you have to be having fun. There are many different ways to make money as a trader that are not fun. And if you're not having fun, don't do them. Use the ways that you enjoy doing. Some people like limit order trades. Some people like scalping. Some people like swing trades. If you're profitable and you're happy, what else can you ask for? Whatever suits your personality, if it's profitable, go for it. Most traders will make more money looking for trend days in swing trading and entering on stops. Now, I said there are a lot of signals here. And why is it difficult to make money? Because of the trader's equation. Trader's equation means the percentage of the time that you win times your average size of a win must be greater than the percentage of the time that you lose times the average size of your loss.
Okay, now this is so important. This is something very few traders know, which is called the trader's equation. So screenshot this and really study this here because it's one of the most important keys to structuring a profitable trade. And not only that, but one of the most important keys to becoming consistently profitable is understanding this math equation.
A scalp means you're going for a small reward relative to risk. So you have bad risk reward. And in a trading range, the probability is never as high as you want. Things are never as clear as you want. You're buying when it looks bearish and you're selling when it looks bullish. So you have bad risk reward and the probability is not especially high. And that combination makes it difficult to make money unless you're an experienced scalper who can scale in and not panic and not do the wrong thing.
Okay, now he's saying the probability is not especially high. Why? Because look, there's a lot of long trades and a lot of short trades. All the green are long trades and all the red are short trades. Okay, so if you have just as many short entries as you do long entries, then the probability is about 50-50. Okay, so that's not very good. That's like low probability, or slightly above 50-50 is pretty low, right? So you don't have high probability like you do in a trend. However, you do have a lot more opportunities. And Al is pointing out one of the biggest parts of the scalping trap, which is that traders panic. They panic out, okay? So we've identified one problem already, okay? That is that traders use tight stops. If you use tight stops when the market's doing this, you're almost guaranteed to get stopped out. So that's one of the biggest reasons that scalpers lose money, okay? The second is they panic.
What happens with beginners is they tend to sell out of longs at a time when they should be buying more. They tend to buy back shorts when they should be selling more. And because they're not doing the right thing, they end up losing money.
Again, with reversals in trading ranges, you need to think in terms of the opposite of a trend. It's a complete opposite thinking. So instead of thinking that when the trend is strong, that you need to enter and get it on the move because this baby is going up, all right? It's the opposite. You need to expect that the price will look bullish and look strong and then do the complete opposite. Same with bearishness. Look at all these bear bars. Strong breakout to the downside. Pause. Another strong breakout to the downside. You're like, okay, look, this baby's going down. We've got all these strong bear bars. But then look, the price did the complete opposite, okay? And then same with here, right? Looks like the price is breaking out to the upside. This bull bar closed above how many bars to the left? 30, 40, 50 candles to the left, okay? So it looks very strongly bullish, but then the price did the complete opposite. So for scalping, you need to think in the complete opposite way with the complete opposite logic that you would use for a trend.
Scalpers, they can improve their trader's equation by increasing their probability. They know what their risk is. They know where they put their stops. They know what their reward is. They're going for a scalp and they know how big it is. And they can improve their probability if they use wide stops and scale in. And that can make it a profitable strategy, scalping in a trading range. You can increase your probability high enough so that it overcomes the bad risk reward.
Okay, now this is the third key to why traders lose money when they're scalping, okay? So we said the first reason why most scalpers lose money, the first biggest part of this scalping trap is tight stops, right? That's number one. Number two, we just said it, okay? We just said number two, okay? So remind me that you're listening and tell me what we've noted so far as the biggest reasons why most scalpers lose money in a trading range, okay? So I want you to list those in the comments.
I said scalpers often use wide stops. So for example, if a bull bought that bear close, or if he bought above this bull bar, instead of exiting below a bull bar, he might use a wide stop, maybe a measured move down based upon the height of this trading range. And the opposite's true here. If he sells that close or sells below that bar, instead of exiting just a little bit above, he might use a wide stop, maybe based upon the height of this buy climax bar, and then look to add on higher. Now, we have a big bear bar closing on its low. If we had consecutive big bear bars closing near their lows, it's probably worthwhile exiting before
I just pointed that out to you guys, right?
your stop is hit. Not necessarily though. Some scalpers will use very wide stops and scale in, knowing that even if you have a big breakout in a trading range day, if you manage it correctly, you can usually still make money.
Okay, I want to draw your attention to where he's showing his stop, okay? Look, if you are entering up here, notice his stop is not here. Okay, a lot of traders would put they'd enter here and then they'd put their stop here. You know, this is most of the amateur traders that use these little teeny tiny, like just little baby stop losses, right? They can't handle any risk, or they're using too much leverage, okay? So they have to keep their stops really small and it screws them up, okay? And trust me, I've been there, okay? I've made that mistake myself. But look at his stop. He's using a wide stop. It's all the way up here, right? Which gives the market room to move, and it gives you a buffer in case that you're wrong so that you can adjust. Same thing down here. Look, the stop's all the way down here, okay? So I want you to notice that wide stops give you time to make decisions and also give the market room to move so that you can actually adjust.
In general, it's better if you have a breakout with consecutive closes below, get out of longs. If you have a breakout with consecutive big bull bars closing above, get out of shorts. Why do beginners lose with limit orders? Well, let's talk about it. We have a big move up, a big move down, and now another big move up. Big up, big down creates big confusion. Confusion is a hallmark of a trading range. So when you see that, you got to be thinking that
big up, big down. What does that mean? Another way of saying it, lots of reversals. Look, huge bull bar to the upside, then it reversed down, then it reversed back up, then it reversed down, then it reversed back up. Okay, so you're getting lots of reversals. That's what big up, big down means.
Probably entering a trading range, even though we have several very big trend bars, bull and bear trend bars. Scaling in and scalping, you have a very high probability of winning. A good scalper can win 80 or 90% of the time. And the problem for the beginner is that there's occasionally going to be a very big move against your position, and you will exit at a time when you should be adding on. And the result is one big loss can erase a whole bunch of winners, and you end up losing money. Once you suspect that the market might be in a trading range, you'll start to scalp if you're going to trade. A lot of the scalpers will be limit order scalpers. They'll look to sell with limit orders. For example, anytime they see a high, they might place a limit order to sell at that high, get filled here, and then exit with a scalp down here. If this is the E-mini and the range is small, the bars are small, they might be scalping for 1 point. If the bars are bigger, if the day's ranges have been big, they might scalp for 2 points, 4 points, 10 points, depending on the size of the bars. He'll place a limit order to buy at a prior low. He'll buy here. He'll buy more lower, get filled here. Might buy more 2 points down, 3 points down. He can get out break even here. When it gets back to his first trade, he gets out break even on the first buy.
And notice the only way you could do that is if you were using a wide stop.
And with a profit on his second buy. And he can keep doing it all day long. As long as he thinks the market's in a trading range market, he can sell at a prior high, sell there, sell more higher, sell here, sell more higher, get out break even on the first sell, and with a profit on the second sell, and just keep doing it all day long. Buy at a prior low, buy more lower, buy more lower still. But look what's different here. We have a bull channel, we have a trading range here, we have a bear bar closing near its low, we have a second bear bar closing near its low.
Okay, so this is what you could consider a break of structure or a shift in the character of the market. All of this has lots of tails on bars, and this looks very trading range price action, like we've been pointing out this entire video. But he's showing you that when this happens, these two bear bars, this pair of candles right here at the very end of the chart here, there's a difference happening. Something different happened right now, okay? So all of this was following the same pattern more or less. You were following a trading range, price action, behavior. But then here, suddenly, a new shift occurs.
Breaking below the lows of this trading range and this bull channel. Remember what I said earlier. If you start to get a pair of decent-sized bear bars closing on or near their lows, breaking below something, breaking out of something, it's usually better just to exit. An experienced scalper comfortable using wide stops will continue to add on. He might take one limit order trade here, one limit order trade here, and then stop and look for a stop order trade down here.
Okay, so I want to say something about that. Now, you might be tempted to go and use wide stops now. However, using wide stops, I've found, like really wide stops, is really not ideal either. Okay, so you don't necessarily want a tight stop and you don't necessarily want a really wide stop, but you do want to be able to find something that gives you some kind of middle ground. Okay, so the price does have room to move, but then if the market goes against you and the trade just doesn't work out, like this is just called getting unlucky, right? The price was following the same pattern, and if you were using a scalping strategy and then it did this, you just got unlucky, and that happens. But you have to plan and prepare for that. So the key there, I would say, is just rely on your stop and allow yourself to get stopped out, and you would be totally okay with that if you're predefining your risk before entering every trade. Do you predefine your risk before entering every trade? Yes or no? Tell me right now in the comments.
Pair of consecutive big bear bars closing on their lows, closing below the moving average. These bars look different from all of these bars. These bars have small bodies and prominent tails. And here we have two consecutive good-sized bear bodies with very small tails and closing on or near their lows. The character of the market is changing from a trading range type of environment into possibly a trend. Most traders should get out once they see that. If they're a long scalper, if you bought here, and bought a third time here, it's better just to get out here. But some traders will just use a wide stop after a second or third entry and then wait and buy above a bull bar, betting that the market will come up high enough for them to avoid a loss.
And if you have to get out, you have to get out. Remember what Tom Hugard says, the best loser wins. Your ability to know how to lose and to lose well is one of the most important skills in trading.
For example, you buy here, you buy here, you buy here. You might exit here, but an experienced trader might double his position as soon as he sees a bull bar closing near its high. If he bought one contract and then a second and then a third, an experienced scalper might double that and trade 6. So he was trading one contract all day long, sometimes 2. Now he's trading 6. And that is the problem with limit order scalping. A beginner is never going to be able to do that. If he's comfortable trading 1 or 2 contracts, he's probably not going to be comfortable trading 6. To trade it correctly or optimally, that's what he has to do. What instead he'll do is he'll panic out there or here with a very big loss, when instead he should be looking to buy. So big bear breakout, if you did buy, it was reasonable to buy that and this and that. That was all reasonable because it was trading range trading. But after you have these 2 big bear bars, it's no longer a trading range trade. It's now a trend. But it's still possibly simply a test of the low of the trading range. And therefore, a trader comfortable with a very wide stop can hold long and double his position size. If he only bought 1 here and did not add on here, doubling his position size here would be buying 2. If he bought here and here, but not here, so he's long 2 contracts, doubling his position size would be 4. So if you're going to sit through a big bear breakout and wait for a reversal, I personally like to double my position size there. A beginner who thought he was trading small enough suddenly discovers he's trading too big. And that's the problem that beginners have with limit order scalping and scaling in. They can win all day long, and then something like this happens, and it's different from what they've been doing all day long. They mess it up and they lose a lot of money. The bull who bought here, and then doubled his position size here, he had to incur a lot of risk, but he got paid for that risk. He got out break even on his first buy, a profit on this buy, a profit on this buy, and he bought 3 contracts here and he had a big profit. And that offsets the big risk that he was taking.
And I don't like that. I don't like doing that. It's too much pressure. It's too intense. I don't think it's a good idea for anyone. Okay, what you do is completely up to you, right? And you have to decide for yourself how to trade. But personally, I like to just keep my leverage small. And if I need to get stopped out, I get stopped out and I rely on my stop because that's what it's there for. Then pause, take a step back, give the chart a little bit of time to work and reassess what's happening. And then I can get back in if I choose to, but only after I take a break and I cool off.
The fundamental problem with a beginner is he thinks he's trading small enough to handle a big move against his position. You'll sometimes get a move that makes it clear that he's still trading too big, and that occasional big loss wipes out all of his earlier gains. You have to trade the I don't care size until you can handle the occasional big bad surprise. By the I don't care size, it's a size that's so small that you don't care if the market goes against you. You can just keep adding on appropriately without worrying about losing too much money.
Okay, now how many is that? How many contracts is that if you're trading futures? 2 or 1, okay? 2 or 1. Easy answer. Only trade 1 or 2 of whatever you're trading. That's the easy answer. Then you never get carried away. Then you never have to deal with this kind of problem. Then you never blow your account.
The goal at that point of your career is not to get rich. Your goal at that point in your career is simply to develop trading skills. You're trying to get good. You're not going to make a lot of money, but if you trade well, you'll consistently make money. And at some point, a year, 6 months, 2 years, your account will be big enough so that you can trade a bigger position and then start thinking about making a lot of money. But initially, when you're starting out, your goal is to not get rich. Your goal is to stop losing and then trading consistently, profitably, and making a little bit of money consistently, and then trying to grow your account. Those are the initial goals as a trader.
Okay, slow and steady wins the race. I'll say it 100 times. Slow and steady wins the race. Remember the tortoise and the hare?
Now, scalping and trends. Some traders can do it. Obviously, a very strong bull trend. You only want to buy. It's a small pullback bull trend. There are pullbacks, but they're all small. 1 or 2 bars, they don't fall very far. When you see that, it's very difficult for a bear to make money. If a bear sold at the high of this bar, the pullback never went below that high. So if he sold at that high, got filled here, sold more, he tried to get out break even, it never got here. He had to cover with a loss. And there are many gaps all day long. So bears selling at prior highs kept losing money. Limit order bears are not making money. And if limit order bears are not making money, stop order bears are not making money. So bears are not.
And this is why scalping in a trend, strong trend like this, doesn't work. Pay close attention to this, right? Because if you try scalping in going counter trend, when the chart looks like this, you will get wrecked, okay? So you can scalp when the chart looks like this, but if you do that, it's got to be with trend, not counter trend.
Not making money. If it's really hard for a bear to make money, the market has to go higher to find a price where bears will sell. All day today, the market never found that price. You only should be looking to buy. If it's very difficult for a bear to make money, only look to buy and do it all day long.
So here's all the entries and the exits.
And you can buy for any reason. You can buy above the high of a bull bar here. You can buy above that bar, above this bar, all day long. You can buy a bull close. Anytime you see a bar closing near its high, you just buy the market as soon as the bar closes. You can do that all day long. You can buy bear closes because the bears are not going to be making money and every attempt to reverse down is going to fail. So a bear bar, you buy it. Bear bar, when it closes, you just buy the market. You can buy when the market finally pulls back to the 20-bar exponential moving average because the first time it pulls back, traders will buy it expecting a new high.
And that's one of the best setups on a trend day when the chart looks like this. And notice the market's only going to look like this, say, a couple times a month, maybe a couple times a month. Okay. If you're trading the ES or the NASDAQ. So this is one of the most easy setups to identify because look at the moving average. Okay. Blue line moving average. Look at how often we touch the moving average. Not once, not once. This is the open of the day. Not once. Okay. So we are getting close, but we're not getting there. We're not getting there. We're not getting there. And then look what happens the first touch of the moving average. Now, if you're confident that the market is trending up, then entering as soon as we touch the moving average is one of the best setups there is because the high likelihood is that as soon as the price touches that moving average the first time, assuming it's a trend, that traders will buy that because they've been waiting to buy the average price all day long. And that's exactly what happened here.
You can buy the moving average all day as long as the trend is strong. You can buy below the low of the prior bar, especially if it's a bull bar or a doji bar. A bull bar here, you place a limit order to buy at its low. A doji bar here, not a strong sell signal bar, you place a limit order to buy at its low, and you can buy more lower.
So there's a lot of different possible strategies here, right? This is where some people start getting confused because Al's throwing a lot at us here, okay? So you don't want to get lost in all these different options. You just want to pick a setup and trade a setup that works for you, okay? So you want to have one setup that's going to work for you when the chart looks like this and know what that is, and just pick one.
Bull trends are constantly forming wedge tops. There's a small wedge, here's a wedge. All day long, they form wedge tops. But the wedge tops are going to fail and lead to bull flags. The reversals will be bull flags.
And that's what I like. I like flags. When the market looks like this, I like to enter with flags. So the easy way to do that is you just draw a line showing the bear trend, okay, or the pullbacks, okay? And then as soon as the price breaks in that direction or above that line, then you enter. It's one of my favorite setups.
Flags will be brief and not fall very far. So if you're shorting, which you should not do on a day like this, you're scalping. You should not be shorting on a day like this. When it's very difficult to make money selling, you should be buying, and you have to get long. Even if you have to trade a very tiny position, you have to get long. Now, it looks like you can buy, scalp, buy, scalp, buy, scalp, buy, scalp, and do it 20 or 30 times all day long. But most traders should not trade that way because what will happen is they'll do it once or twice, and then they'll never get back in. They'll constantly be thinking the market's too overbought. It's starting to form too many wedges. It has to pull back. It never pulls back far enough so that you feel the risk is small enough to buy. And the result is you buy and you scalp out, or you buy, you scalp out, do it 2 or 3 times, and then you never get back in and you miss a huge trend day. If you find that you're doing that, don't scalp out. Just buy and hold and wait until the trade is no longer valid. Today, it was valid all day long. There's really no need to get out of a long. It doesn't matter which of the buys you took. You just buy, hold. You can get out a point or two below the low of the prior bar. You can get out below a big bear bar closing near its low and just buy again above a bull bar closing near its high. Most traders should just buy, use a wide stop, and hold, and let the trend go on until it's no longer a trend. And today was a trend all day.
Okay, now how often does the chart look like that? So this is a trend day because it was trending all day. How often does it look like that? We got a question in the comments about that. Now, look at how this looks, okay? We went up all day. And then look at the second example, same thing, but in the reverse. How often does the market do that? About twice a month, okay? So if you're trading the ES or the NASDAQ, that's gonna be like maybe once a week, maybe once every 2 weeks, okay? So it's not very often.
Money, if there are a lot of gaps and body gaps.
However, when the chart's doing that, that's when there's a huge opportunity, okay? So sometimes, and for some traders, it's better just to wait for those.
Pullbacks are small, the bounces are really small. Don't buy, only sell. A trend like this, it's a breakout on a higher time frame chart, a micro channel, every high at or below the high of the prior bar.
And that's a great tip. If you're not sure what's happening here, because this actually exhibits some of the signs that we pointed out earlier. There's a lot of tails on all these candles, right? So this could mistake you. This could confuse you. This could throw you off. So if you want a way to kind of double check yourself, look at a higher time frame. This is presumably a 5-minute chart. This is a 30-minute chart. This looks a lot more clearly a trend than this does, right? So going up and just looking at a 30-minute chart or a 1-hour chart can really help you get an overall sense and a more clear idea of what the market's doing. Then you can go back to the 5-minute on your shorter time frame and identify your entry.
So a very strong trend. You certainly would not be looking to buy anything that looks like that. Well, this looks like that. This is what it looks like on the 5-minute chart. The pullbacks are all small. We're below the moving average all day and very difficult for bulls to make money. They can't make money with stops. They can't make money with limit orders. Only sell.
And another tip and a really easy way to do this that I just kind of made up for myself when I was starting out. Because when I was starting out, I just wanted really easy to understand ways of trying to get a sense of what the market is doing. And that is you can count the streaks, okay? You can count the streaks. So if you're not really sure, right, you can't like really look at this chart and like know exactly what's happening. And a lot of times it's sort of confusing. You can use the little trick called counting the streaks. So how many consecutive candles are the bulls getting? How many consecutive candles are the bears getting? Notice, bears got 1, 2, 3, 4, 5 consecutive candles, okay? So one streak, 5 candles. Look at the bulls. Got 1, couldn't even get 2, okay? So bears, 1, 2, 3, 4, 5. Look at it like points on a scoreboard, okay? Bears got 5 points, bulls got 1 point, bears got another point. Then bulls got 2 points, okay? So we got a streak here. But then that's as much as they could get. So 2-point streak, 1, 1, 1, 1, 1, 1. And then you can see 1, 2, 3, 4, 5, 6. Bears are getting 6 points. Okay, 6 points on the scoreboard. So 6 candle streak, 1, 2, 3, 4, 5, 5 candle streak, 2 candle streak, 3 candle streak for the bulls. Okay, so you start to add these up and you could say, okay, bears look stronger. And then you just literally add them and do the math. It's addition and subtraction. If you can add up and subtract, then you can use this strategy. And then whoever looks like they're getting the most streaks and the biggest streaks most often, then you go, okay, maybe there's my bias.
You can sell below a bear bar, closing below its midpoint or near its low. You can scalp, but the problem a lot of traders have is once they take their profit, they never sell again. And if you find that you keep getting trapped out of trends that last all day because you're scalping and you can't get back in, stop doing that. Trade very small so that you're not thinking about money, and you sell and you hold. I sometimes make the comparison to Forrest Gump. Don't give it a lot of thought. I think you could argue that Forrest Gump would probably be a better trader than Albert Einstein. Don't think too much. You just take the trade, put the stop in, and if you want, go to Walmart and come back in a couple of hours.
This is one of my favorite things that Albert says. He says, okay, so get this. He says, if Forrest Gump and Albert Einstein were trading, who would make more money? Okay, post this in the comments right now, okay? I want you to post this in the comments. Place your vote, okay? If if Albert Einstein was day trading and Forrest Gump was day trading, who would make more money? Who do you think? Einstein or Forrest Gump? Post it in the comments right now.
Most traders should be looking for trends, and most traders should be swing trading, and most traders should be entering with stops. When you have a trading range and it's very tight like this, It's possible to make money. You could take a few trades, but most traders are better off not trading at all and just waiting until the market starts to trend again.
Okay, so I would say don't trade when it's like this if you're a very, very new beginner. But if you know what you're doing, you can take some of these trades, but keep it minimal. That's probably the best advice there.
Tomorrow,
But obviously, it's up to you.
for example, or the next day.
Okay, and we're getting some comments in the chat. People saying Forrest Gump. Yeah, this is Al Brooks, who's a medical doctor turned trader. Brilliant guy, okay? And he's saying, don't overthink it, okay? You just kind of keep it simple when you're trading. Like, think like Forrest Gump. Okay, price going up, buy. Price going down, sell, all right? So keep it simple. Don't overthink it because, yeah, Forrest Gump might make more money than Einstein. It's crazy, but it's true.
You'll have a better chance of making money if you swing trade. And if there's a trading range and it's very tight like this, reversing every few bars, there are not going to be many profitable swing trades. The tighter the range, the less you should trade. And most traders should not trade at all on a day like this because there's very little chance of making a swing profit. The reward is small compared to the risk. The probability is not high enough to overcome the bad risk reward. Unless, as I said, you're a limit order scalper who's willing to use wide stops and scale in. Most traders will not do that successfully, and most traders will not enjoy it. And therefore, you should look for days where you have trends and where you can swing trade and where you can enter with stops. This is the kind of day you're looking for. If you don't know how to enter and it's going up without you, look for any bull bar closing near its high and buy with a stop one tick above the high of the bar and put a stop.
And what I like, as I said before, is I will connect the highs, right? Every time you get a pullback, and I will wait for the price to break above that bull flag. It's called a bull flag. Okay, so that's my favorite setup when the price is doing like this.
Stop maybe below that bar and just hold until it's no longer a trend. No one likes to buy at the high. Everybody wants smaller risk. But when the market's in a trend, that's what you have to do. All you have to do is do it one time. Take any one of these buys and then put a stop down here and just hold. If you find yourself being tempted to exit all the time, as I said, go to Walmart, put a stop in and go to Walmart and come back in a couple of hours.
And I want to say something about that because I actually tried this, okay? I got this recommendation from Al and I actually tried it. And for an entire month, guys, I placed a trade. I got up in the morning, I did my preparation, I got to the chart, I did some basic analysis, and I placed a trade. And then I left the house for an hour or two and I came back and I did that for an entire month. And I had the best performance of my entire trading career. So I can say that that experiment absolutely can work, and it can be very powerful for discovering some new things about your trading and really what's possible and probably how much you're getting in your own way.
Opposite's true in a bear trend. Only look to sell. The more the market is trending, the more important it is that you should be trading and only trade in the direction of the trend. Strong trends never look like they're going to last, but they can last all day. So get short, put in an appropriate stop above a prior high. If you sell anywhere in here, your stop is up there. Once you get a new low, you put a stop up here, and you just keep doing that all day. 6 consecutive bear bars closing on or near their lows, a very strong breakout, and it's a warning that it could be a spike and a spike in channel trend. So a spike down and then a channel, a series of lower highs and lower lows. And you sell for any reason. You sell reversals down from the moving average. You sell strong bull bars closing near the moving average. You sell at the moving average with a limit order, and then you put a stop above the most recent high. A new low, put a stop up here. A new low, put a stop up here.
Again, remember what we were saying earlier, right? When the price touches the EMA or the moving average, that can be a great trend. And if the price is clearly trending down, which it looks like it is here after 1, 2, 3, 4, 5, 6 consecutive bear bars, when the bars are getting bigger in size, showing accelerating momentum to the downside. This is a clear, multiple things that you can see about this highlighted portion here, showing strong momentum to the downside. So when the price looks like this, then it's likely that the price is going to continue down. So as soon as we touch the moving average, that's one of the best entries that you can get there, as long as you have some clear indications that there's strong downward momentum. And look, that's exactly what traders did. Look how many bought. Look how many sold, rather. Like everyone pretty much sold as soon as we got to the moving average, and then boom, you got another move down. The scalping trap, okay? Now, if you want more information, more details on my strategy, go to the link in the description. I'll also include the tools that I use, including TradingView and the prop firm that I like and currently have a funded account with. Link in the description for that. And if you go to tradesbybrent.com/3setups, I'll give you a free download where I break down my 3 favorite trades, which includes the pattern I look for, how I limit my risk and set my stop loss, and then also how I take my profits so I can get out before it's too late. Tradesbybrent.com/3setups, or just hit the link in the description. Hit the like button if you like the video, and subscribe if you want more, and I'll see you in the next one. Thanks for watching.